Tavi.
Hey guys, can you hear me? Let me try to get my camera on.
We can hear you.
We can definitely hear you loud and clear.
And we can see that your camera is trying to come on, but we can't see.
I know. What's going on? Let's see if weird. All right,
maybe I will ask you to start video and you can confirm. Maybe
I'm doing the same.
Maybe that will work. Yeah, there we go.
Let me switch it to the wrong camera. Hold on. There we go.
There's something black at the top that's hiding.
Yeah, it's coming in. There we go. It should be now. It should be good.
No, we don't see.
No.
Let me ask you to start video again. I'm doing it again.
Yeah.
Okay, let's go.
Okay, hold on.
We managed to see you before. The problem was that there was some kind of a black.
Interesting. I don't know what's going on. Okay, hold on. Let's see. Something going on with this camera specifically. Let's see. Okay, no worries. Let me switch to the other camera that was working. How about that? There you go.
Sure thing. Absolutely.
There we go. That should work now. Let's see.
Yes. Right, we can see you, Tavi.
Perfect.
It's not my high quality one, but it's all good. It works.
How have you been? It's nice to see you again.
Yeah, nice to see you too.
We were very pleased with your presentation the previous time. I think it was very, very interesting. And I would love to see where you think we stand now and what you think we have coming forward. Because if there is one thing that nobody doubts, is that we are at a very interesting juncture. We've had some very interesting markets, and for a very good reason. We had major fundamental shifts. So I'm really looking forward to seeing your input on, what you think is happening with the economy, the markets, and where are we headed from here?
Well, things have definitely changed since Tavi was here last time, right?
Oh, absolutely. Since April, a lot have changed.
Yeah. Well, look, I'm happy to go through some charts, and like last time, if you guys ever want to stop me or say, hey, Tavi, that's too long, let's just pause here. Or if you want to ask questions, we can do that as well. Would that work? That same format we did last time?
That sounds perfect.
Absolutely. Go ahead, Tavi.
Okay, so I think the prior time we had can you guys see my screen okay?
Yes.
Okay, perfect. I think the last time we were talking, I looked at this chart, which to me still is very relevant as an idea of if we're entering an inflationary environment, this does not tend to be very good for the stock market. Prior decades that we've had inflation at the levels on a decade basis. So if you look at the median CPI for a decade, usually you tend to see a sideways market. But this is the first time those two periods, the 1910s and 1970s, certainly was not an issue with valuations. Today, we have a valuation problem in the US, especially in terms of how overvalued companies are in the stock market, which make me believe that we're going to have a pretty tough decade on the equity market side. And I'm going to elaborate on that. I also talked about the debt valuation and inflation, I think, issue, which to me still is one of the most important charts when it comes to forming opinions and macro trends, and what I call it a plethora of macro trends that are going to be unleashed because of this chart. We have a debt problem of the 1940s, inflation problem of the 70s, and also the valuation problem of the 90s, late 90s. And so that creates real political constraints for policymakers. And we always be having to resort back to a financially repressed environment because of those imbalances that we have. Just to go back to the 1970s period, which is not a perfect analog by no means. We've had, not the same debt problem that we have today. We also didn't have the valuation problem, but it's important to see that there was necessary really a 48% decline in the S&P 500 during that period, 1973-74, for us to start seeing CPI begin to really trend lower. Yes, we saw some declines in CPI, but the trend really began to decline, to actually enter a downward shape was really after the decline in 48% in equity markets, which I still think that that's going to be the case here in the US. The other thing that we saw in the 70s was the three waves of inflation, which is, I still think we're going to go through those waves. It's the normal progress of how the macro forces of inflation really occur. But one thing that no one talks about is the 3 waves of unemployment rates that usually follow after the inflation problem. So I just use a calculation here that in average, we see after 2 years, the CPI is in an acceleration mode. You have after those 2 years, the beginning of unemployment rates begin to show some issues. I think, so right now we're a little over 2.25 or so since CPI began to increase. I think we're very close to the beginning of the deterioration in labor markets, which is going to make the job of central banks very interesting once we see that. One thing I've been noting.
Do you think, Tavi, that especially the Fed is going to use its dual mandate nature to in essence, value unemployment as a bigger problem than inflation, and either abandon or weaken its fight of inflation, or you think that's not likely to happen?
No, I think ultimately we will go there, but first, I think they're going to have to allow unemployment rates to grow, and I think it's going to be very tricky because it's going to be very obvious that in the downturn of the economy will be even more clear at that point. And the Fed is still going to have a pretty restricted monetary policy relative to where the economy is going to be. And it's a classic stagflationary environment. I do think at some point, said, which is basically financial repression, which causes this idea of owning tangible assets over financial assets, to me is the most important thing. And I'm going to extrapolate on that thesis as we go. I've always, having issues with looking at the consumer, because the consumer to me is at a breaking point, especially in the US. You have wages are not really following the inflation pace. Number one. So in real wages, growth is actually in a contraction. And on top of it, we've had savings rate actually hitting multi-year lows. And I think that those, where is the money going to come from to really fund and finance the capital to be spent on that? And on top of it, that's going to have an issue on corporate earnings as we go. The other issue with this has to do with mortgage rates being at times at levels that we only seen right before the global financial crisis. I think it's 2007. And so I believe the combination of those factors is really going to squeeze consumers over time. And what's interesting about this is that when we look at the earnings and the shape of the earnings in terms of estimates, they still estimate a 30% increase in earnings for the next 3 years. I don't think that that's going to be the case. I think
I'll take the under.
Yeah, I'll take the under on that too, even in nominal terms. Because I think we're going to see a contraction. And just to use an example, back in the 70s, just looking at corporate earnings back in 73, 74, there was a contraction of about 30% in corporate earnings. And I think if we looked at the estimates and those need to be adjusted, the shift in equity markets in terms of repricing due to those changes is going to be significant in my opinion. And there's a roadmap to equity markets as well that I'm going to get into. So we have this combination of 3 things going on all at once again. So it's the dollar move, it's the interest rate move across the entire curve, and also it's a withdrawal of liquidity from central banks, which is creating the tightening of monetary conditions. If you look at the 3 things here, so financial conditions, the 10-year yield, and the dollar, they're all moving together. It looks like the same chart as you can see here. They're unsustainable, they're interconnected, self-reinforcing, because rates go up, it helps the dollar, that helps financial conditions to get tightened. And so they're all self-reinforcing when you think about it, but completely unsustainable given the fact that we have those macro imbalances. And so you look at global central bank assets today versus the S&P 500. It's very interesting how you still see this incredible. It's really difficult to not make a case of how the correlation between those 2 lines
is almost perfect.
Incredibly strong, yes. But the problem of this chart, there's an issue with this chart, especially on the red line, which is the global central bank assets, because it assumes that the Fed does have $9 trillion in their balance sheet. That's not true. In a mark-to-market basis, the decline we've seen in the bond market and treasury market actually has caused a decline of the Fed's balance sheet of about $1.5 trillion when you assume the notes, bonds, and mortgage-backed securities and TIPS are not at the value that they are actually being valued today in their balance sheet. And so if you assume that, the shrinkage of the balance sheet has been even more severe than the market has been really
many people don't think of the central bank's balance sheet as the balance sheet of a company or of a person, right? It's like a trading account in essence. And many people also don't know, Tavi, that theoretically speaking, when the Fed has profits in its positions, it sends Congress a check. Theoretically speaking, if it realizes, the keyword being realizes, losses, it is also supposed to send Congress a check. But in this case, a check demanding the change, the loss. And we haven't seen that happening, right? Imagine if the debt issue, gets compiled in essence by the Federal Reserve requesting to be compensated for losses it had in its securities.
Yeah. This is, just thinking about the QT, which is unprecedented in the amount of withdrawal, or just the maturity of letting those mature. In other words, the depletion of the reserves that is really being caused by letting those securities mature is actually larger given the impact of the sell-off in bonds. This is so important to see from a liquidity standpoint. But this is happening globally, right? I mean, you look at Swiss National Bank balance sheet assets also contracting, but the largest amount we've seen in history. They are the ones that actually also purchase most of the technology companies, and the decline in the value of those is also a huge portion of the decline in their balance sheet as well. You're looking at Hong Kong foreign reserve assets also been shrinking like we've never seen before. If there was ever a time to bet against the Hong Kong dollar, I think that time is today. I think the asymmetry is really interesting. That's one trade that we have in our portfolio that we think it could certainly happen. Australian money supply, I'm just giving another example of not necessarily a balance sheet of the Fed, but just the withdrawal of liquidity from the system from the perspective of what's happening with the change on a monthly basis of their money supply. We've never seen this level of withdrawal. China's Treasury holdings is another example in a declining trend for a while, and clearly now making decade lows in this environment. So it's creating this decline in bond markets is creating some huge changes in correlations that I think are very telling to what's likely ahead. One of them is in gold versus global bonds. And so we've had this very tight correlation between the two. And now there's a total break on the global bond side, and gold has been holding up very well. There's clearly a relative performance strength here, but also on top of it, I think it's important to know that I think there's an accumulation of smart money happening in the space. The second thing is I'm old enough to remember when the Japanese yen was the safest currency on the planet. It's not anymore. It's been collapsing. First time we're really seeing FX markets and treasury markets and bond markets have started to price in sovereign debt risk, which we really haven't seen that in a long time. And so here's a great example of a country that never made any sense to me of why it was supposed to be the safest currency on the planet. But now here you have it. And I'll get to another trade idea that I think it's really interesting related to this. And then you have another thing that was designed. The name is Treasury Inflation Protected Securities. You buy this to protect yourself against inflation, completely collapse relative to gold. I mean, this chart to me is just insane. I mean, why would you even buy this, right?
But tips, unfortunately, tips, after central banks started messing up with them, they don't really offer proper protection, do they, Tavi?
No, I mean, it's owned 25% or so owned by the Fed. It's not my trade. I mean, it's not something I'm interested in buying. But the question that I think everyone is trying to think is, when is that pivotal moment? When are we going to see the Fed really say, okay, enough is enough. I can't be raising rates to this levels. That's a huge question. And to me is when we see the real dysfunctional side of equity markets in the US or bond markets or treasury markets that we've not seen it yet. And so one of them is in LQD, for instance. Look at this chart. It's now below what we saw in 2020 in the March lows, but it wasn't driven by necessarily by a default risk. It's been driven by duration risk, meaning interest rates have been rising, and so it's causing the decline of investment grade bonds. In my opinion, how do you really measure that is looking at credit spreads. Credit spreads are still very tight, still at 1.52. We're long credit spreads. We think we're going to see a blowout in spreads at some point. So we're long treasuries and short junk bonds and investment grade bonds as a part of that trade. So you can see that spread likely to blow out as we continue to see the development of a downturn in the economy here. And so this, to me, tell me the last time NASDAQ was down somewhere close to 30+% and credit spreads were below 2%. There was never a time that we've seen that. So to me, this is a trade.
And in my opinion, something that resembles a little bit what you're showing with credit spreads is the VIX as well. The VIX has been contained very, very well, right? I mean, if you had no idea what the markets were doing and you could just look at the VIX, you would never imagine we are this much lower as we currently are, right? You would have imagined that we've been in a very, very mild correction.
Well, and the interesting part of this is, I was always very bearish on stocks, but I thought, this is honest thought, I always thought the corporate market was going to be one of the leading issues of this. And I've been wrong about this, even though the chart has been going on my favor. I haven't seen yet that dysfunctional side of that, like we saw in the COVID crash when liquidity dried up and we saw a major decline in corporate bonds, given not the duration risk, but really the default risk being reflected in those instruments. I think we're going to see that. That's my 2 cents. And so 10-year yields today around 4%, are now a little higher than that, 4.2. It's just so hard to keep those charts updated because everything's moving so quickly. But
on a weekly basis,
and the Fed funds rate, I mean, if they raise rates to 75 basis points, which is, I think it's what's priced in right now, it would basically invert the yield curve intentionally, right? Because it's not being caused by 10-year yields falling. It's being caused by them rising the Fed funds rate faster than the 10-year yields. To me, I calculate the percentage of inversions in the yield curve. Right now, we're around 50%. I've never seen a time when we get to 50% that we don't keep going. So I think there's more yield curve inversions. This is another trade that I'm interested. And so I think we're going to see this get to the 70% level. 70% is an important handle. Historically, every time we've seen the 70% of inversions in the Treasury curve, it coincided, not preceded, with the downturn in risky assets. It's not about calling a recession. It's about calling the decline of risky assets. We're here to make money. We're here to get the direction right of markets. And to me, that's one of the strongest signs is when you get the 70% handle in the yield curve inversion. Again, historically and empirically, we've always seen that to follow. So it's another one to adding to my opinion of being bearish in markets. I looked at growth versus value, just the ratio between the two. We're still at levels that are close to the tech bubble, which to me is still a problem, obviously. I still very bullish on the value side, very bearish on the growth side.
I see people, Tavi, doing this mistake all the time. They see how much some of these stocks and assets have deflated. And they just look how much we've moved from the high. They don't realize that the levels we are currently at are still, in historical standards, not just elevated, but extreme. We're still at extreme levels. And they don't realize the amazing potential downside that we could still see.
Well, Steve, that's the young crowd, right? I mean, the folks that have not really experienced those declines are not really interested in history. it's been a relatively easy market. Everything that you invested that was sexy related to growth did very well. Everything that is boring, that is value, that actually matters in terms of profitability, bottom line, has done terrible. And that's changing because now cost of capital is higher. This was kind of our conversation prior year. Cost of capital is going to be higher. Value is going to be something that we want to be focused on. There's a lot to be unleashed on that side still, a lot of things to be invested in. This chart, to me, for any young guy who has not really experienced a downturn, be careful. I mean, it's still a peak of the tech bubble valuations for market cap to GDP. There are other valuations you can look at. Majority of people that are bullish in the markets are either using pure technical indicators to say that everything is oversold, or they're using forecast for earnings, which is a forecast and it is massively inflated, and looking at that relative to prices. To me, that's the very, very wrong way to be looking at this.
Forecasts for earnings, especially in shifting periods that like the one we have now, are so much backward looking that they can end up being insanely wrong, and people don't realize that, because all the assumptions that build those earning forecasts can be materially changed within a matter of just a few weeks.
That's right. So then it becomes the question: if you're a money manager, you're kind of planning, what's the roadmap here? What are we going to do here? How do we invest here to protect capital and grow capital at the same time? Well, let's look at a few things that are the darlings of the prior decade, and the darlings, the most successful businesses and investment vehicles and investment approaches we've seen that really drove us to this insanely speculative environment we've seen. Venture capital, one of them, now back to the March lows, down 62%. ARK Investments, a great other example, now at the March lows.
Tavi, I don't know if you know that.
Yeah.
We made a big effort on the April event to bring Cathy Wood to debate Peter Schiff. And the reason I insisted and I pulled as many strings as I could and I tried so much to get that to happen is because I was so much convinced that whatever she owns is going to be completely destroyed. She had already started having losses, but nothing in comparison. I think now ARK Innovation, I think now is like 80% or even a little bit more than 80% down from its highs.
Yeah.
I mean, for me, that downfall was so apparent, right?
Yeah. I mean, this industry is difficult. I mean, once you get to that level of losses, your credibility is gone. It's going to be very difficult to turn this around in the short term. And so, and then you have Chinese stocks. We got out of the COVID crash, as you can see in this chart. This thing just shot up from 50 level to 100. And now we're seeing this collapse in Chinese stocks, which started with the crackdown on ADRs. It started with the crackdown on big technology companies. Then it kind of began to show issues in the housing market. Banks, most of the largest Chinese banks are down also, 50+% from their highs. And so I just keep looking at this. I mean, everything is below their March lows already, or at their March lows. Let's look at another one that I think it's important. Software stocks. That's an industry that actually made money. However, it was valued at ridiculous multiples. And I remember
Zoom,
this. Yeah.
Zoom, DocuSign, Zoom.
Peloton.
I know that Peloton is not the same type of company, but it also had that huge beneficial rally due to COVID.
Yep.
And when I was seeing its earnings, and I was telling my partners, like, oh my God, these guys can't make money even in the most unique, special, privileged conditions they will ever find in history. Imagine what's going to happen to the stock, once everything goes back to normal, right?
That's right. Peloton. DocuSign reported earnings one day, and in beginning of actually in the middle part of 2021, the stock declined 40%. It never looked back. It's been declining since then. It's now below its March lows as well. There are other examples here too. On the FAANG side, if you look at the large mega cap companies, Well, here's Netflix. Even after their appreciation, they're just retesting their March lows right now. So, another one to think about. Facebook. Here's another one.
Sorry to interrupt you. Speaking about Netflix, I think these guys had a double whammy, because on one hand, they had these amazing conditions under COVID, which of course are going away. They've already mostly gone away. But they also had something extra happening during the same period. Competition increased substantially.
Yeah.
And this started draining subscriptions. And now, if you add the diminishing capacity of people to just spend on, have this discretionary spending, that's a triple whammy, right?
Yeah.
So I think there's more downside for those guys as well, Netflix and the rest.
Yeah, and as a short part of our book is very focused on things that have not gone yet to the March lows, like the Apples and Teslas and Googles and Microsofts and so forth. And just assuming if that's the roadmap, if all the darlings are already at the March lows, and obviously, if you're looking at this just like, oh, this guy's being dramatic, we're going to go down under 40%. No, it's going to be a roll. We're going to have bear market rallies, but I think the direction is lower. So we as a fund have been systematically increasing our shorts if the market goes up. And then we have those flushes. I think we're yet to see a big flush in the markets that will scare a lot of people. But I think ultimately we're going to go to levels like those darlings have been trading. Here's the S&P, about the same 40% decline from here if we're going to go see something along those lines. And remember, right after our conversation that we had last year, Barron's came out with the unstoppable
rise of big tech.
Big tech.
These amazing contrarian headlines, right? Always.
Right. This is a very difficult when you see that. I collect newspapers, and this is one that is in my collection because I just thought this was a classic cover that I wanted to have. This is FAANG Stock's Real Growth, by the way. While everyone is focused on those, hefty multiples that they have, growth multiples they still have in some of those companies like Apple, for instance. Well, the growth in real terms has been declining, which is very, very interesting. And look, go back to this chart. The commodities to equity ratio. Tavi, you're going to show this again? Yeah, I'm going to show this chart for the next 10 years because that's the chart that everybody should have in their living room, in their bedroom. They should wake up and look at this chart and think, how do I make money on this? Because there are two trades here. There's really the commodity side and there's a short side of financial assets that are expensive. And I think about this. This is not 08. This is really not what we saw back in the global financial crisis. If you just adjust commodities, CAPEX cycle relative to GDP, why? $10 million spent on the ground today is not the same $10 million that you spend in 08. Labor market's more expensive, materials are more expensive.
Inflation has diminished the purchasing power of the same money by a lot.
The economy is larger, compared to 08. So
yes.
When you adjust for those things, which I think adjusting for GDP, you get the inflation and the size of the economy and so forth, you can see we're making new lows on this. And so to me, 08 was quite the opposite. We had actually we've been through a large infrastructure development and overspending in commodities during that period that started in 2000 and ended in the global financial crisis. And some commodities actually in 2011. So to me, that's really, really different environment to be looking at. And remember, commodity producers today, which I think is the most attractive part of the market. If you look at them, they're doing everything they can to attract capital. They're doing more buybacks and dividends than what they do on CAPEX. So in other words, they're returning more capital to shareholders.
Instead of investing it to extract more. Yeah,
that's right. So when have we seen this? Never. And so to me, this is, it's just a classic. So, okay. So we came up with this CAPEX charts in commodities 3 years ago, and it became a popular idea. Now, let me tell you what I think it's going to be the next popular idea, because I think that's the important side of it. And I think some people start to catch on to this. I think we're entering a very deglobalized world. A lot of people agree with that. And that will cause developed economies to really reshape the manufacturing of their own countries. And when we see here this chart, US manufacturing relative to GDP used to be 30% back in the 50s and 60s, and today is at 10%.
10%.
To me, this is going higher, right? I mean, it has to be going higher.
And it goes hand in hand. If you remember, that was one of the points on which Trump was elected, right? Of course, I'm not saying that to support Trump, because the reality is the following. Did Trump do anything to shift that trend? The answer is no. He talked a lot about it, but absolutely nothing changed under his administration having to do with manufacturing.
That's right.
The problem is that along with this trend, we had the other trend that was developing at the same time that is 100% correlated practically, is switching the model of the economy to consumption-based, which anybody that is worth their salt as an economist knows that real wealth is not consumption, it's production. Every human being on the planet, with practically almost no exceptions, is willing and wants to consume practically unlimited amounts of things if they can afford them. But consuming is easy. Producing isn't easy. That's where the real wealth is.
That's right. And to me, you know, remember what happened in China in the late 90s and early 2000s when they were reshaping their manufacturing, when they were building. What happened during that period? Commodities had a bull market. So to me, now we're going to see the G7, most of the large economies having to do that. Europe, US, Canada. So every place in the world is going to have to focus on this again. And that will be the next demand-driven side of commodities long-term, in my opinion. This is going to take a long time to play out. So, you know, we look at global equity markets today versus natural resource industries at about $10 trillion. The difference is massive. You look at that, take out energy and just look at mining and agricultural and those parts of commodities market, uranium, my goodness, it's only $3 trillion of the market. So that is an imbalance that I think it's unsustainable as well. We're going to probably see capital flowing into the green, that green and the yellow bar, and those
from the blue one, from the rest in the blue one.
That's right. And so I looked at mining today, valuations trading at lowest levels since 2008, and that's including base metals, precious metals, and so forth. And I think about it and I looked at it, I'm like, well, 2008, those things are also depressed on the earnings side. Not today. Earnings actually are looking pretty good, even though they've been squeezed by some of the labor costs and cost of materials and so forth. Their earnings are still much stronger than we've seen in other times in history. But also with that, you have the prices of those companies being very depressed. So to me, this is an opportunity on the long side that I like to deploy capital into, is on the metals and mining side of it. I look at gold volume, even though gold has been holding up very well relative to other things. You look at gold volume, it's been drying out significantly. Other times we've seen this certainly marked bottoms for gold. I like this chart. Silver is something that surprised me negatively because I've always been very bullish on silver. This is one thing that probably I wish I would have gotten right. And even though I got it right over the prior years, I still think there's a big trend on silver over time. And it is one of the cheapest metals, and I think it's the cheapest metal on earth. But when I see this silver year-to-date performance having its worst year in 30 years, which is the case with a lot of assets, not just silver, consumer discretionary is having that issue.
At the time that inflation is close to 10%, something with intrinsic value has had its worst year in 30 years. Go figure.
Yeah. So to me, this is another opportunity. Obviously, I've been very focused on this. We've been levering up that trade, not in the sense of debt, but looking for asymmetry on the silver side. As a fund, we've been always allocating capital there. Agricultural commodities, you look technically, I love this chart. Quarterly candles looking at over history of agricultural commodities. We have that big increase in prices, and then now we've been kind of sitting on that support. So resistance became a support, and I think we're going higher from here. And last year I talked about a few ideas. I always have a lot of ideas, not just one, because that's how we see the portfolio. And those were, if you look back in those times, the 10-year yield was one of them. The software stocks on the short side was one of them. The agricultural commodities was another one of them. But one of that I want to talk about today that I think it's even more important is what I think it's going to happen with Brazilian markets. I am very bullish on Brazil, given my opinion on commodities. I think that that's a market that is not really priced the right way. I see the performance.
And for those that don't know you, Tavi has boots on the ground. Tavi is Brazilian, and he is in Brazil, right. So he knows exactly what he's talking about.
And I've never been bullish on Brazil, by the way. I've always been extremely bearish because of the I would say when you live in a place and you see the corruption and those issues that are just part of the culture, it's very difficult to become bullish. But when you study history and you know that when you enter an inflationary decade and people start favoring commodities, you want to favor commodity-led economies. Brazil has energy covered. It's got agricultural commodities covered. It's got a huge prospective ground of mining. And so the combination of that natural resource rich environment, I think is going to be a really positive environment for Brazil. So since the global financial crisis, Brazil is basically flat. US stocks are up about 7-fold. Let's look back during the 2000s, right after the tech bust, when things bottomed. And then we went all the way to the peak of the housing bubble, opposite chart now. So now you have Brazilian assets massively outperforming, while equity markets in the US, we're not flat, but only up about 80% relative to what you saw there. So I'm not claiming we're going to see the white line from here. Do I think it's possible? Yes. I think it's something undervalued, extremely cheap right now, and you can build a position over time, where it's not a big side of our portfolio because I understand the risk, but I like to have a portion of our portfolio allocated to this. I look at free cash flow yield differentials for Brazilian equities relative to US. Every time we've seen free cash flow yields at those levels, we've got into a bull market. I think that that's quite interesting. I looked at the development of Brazilian equities relative to developed economy stocks outside of the US, because US is actually a natural resource rich area. But then if you look at versus Europe or Japan, those places, UK, I think those places are going to be in trouble relative to Brazil. So I looked at the relative performance of this, just like gold has been performing better than other things that are inflation protected vehicles. I find this really interesting. This is another form to see how there's smart money accumulating assets in that part, even relative to the US. So if you look at Brazilian equities relative to US, right now close to a breakout from a very long-term resistance. Now, FX markets are also not reflecting this. So here you have a commodity-led economy versus a commodity net importer of those. And so that is a huge spread between the two. I want to be long, simplistically speaking, I want to be long commodity-led economies like Brazil. I want to be short commodity importers. And one of the ways to do that is right here. You got the carry trade on your favor because the carry is obviously on the interest rate differential is massive between Brazil and Japan. Really interesting trade to me. I think this chart's going to have it higher. I remember looking at this chart similarly in agricultural commodities the prior year, and everything looked like that. It was ready to go. Brazil is one of those markets that have not yet really gone, seeing that upside like we saw in other parts in other commodity markets. And when I look at the commodities to equity ratio chart, Brazil is still at the very early innings of that. So okay, don't get me wrong. If we have a global recession, which that's what I'm hedged for, I have short positions, Brazil is going to get caught up on this too. But it's going to be a very, very important period for you to accumulate capital or assets in that space, because I think we're going to grow from here in that side. And my favorite trade is
we've already seen an impulsive move higher from the lows having to do with the BRL versus the yen. I mean, it formed in essence a double bottom at around 18, and it has exploded higher since. But as you said, if somebody zooms out in the chart, they will realize that there is a lot more upside there, a lot more upside.
Well, my favorite one is really buy Brazilian assets and short Chinese assets, and mostly on the Chinese currency side, because I've been a believer that China will devalue its currency a lot further than people believe. It has reset its monetary system 10 times in the last century, or actually 9 times, I should say. In 1994, their currency devalued by about 30% in one day. That is unthinkable today, okay? And in fact, it is not priced in implied volatilities of those markets. And so I like that. I think we're going to see not necessarily a 30% decline in one day, but I do think that we're going to see worsening, not improving in China, and probably going to see improving side of it on the Brazilian aspect. The elections are important. I think if we have a pullback, if Brazil declines on a pullback because Lula came in, you know who is going to be buying. I'm going to be buying in that pullback because I want to build a position, and I don't build a position all at once. I'll build slowly until I grow into the size that is a very high conviction trade.
Related to this, we have Richard asking, he says, one problem with Brazil is labor force and costs there are higher, including corruption, than the rest of Latin America. Do you think that this will hold up Brazil relative to these other neighbors like Chile, Colombia, Paraguay, etc.?
Well, look, if you think about partnerships that we're going to see from developed economies, Africa is basically bought by China, right? I mean, China is all over Africa. South America, if I would belong a region in the world, it's South America, because I think South America is unexplored. We know it's underdeveloped, and also it's a place that is geopolitically neutral. Most places, Brazil,
that is true.
Sell things to Russia, sell things to China, sell things to the US, to Europe. It's just, it literally, it doesn't matter. And so now, as far as corruption, it will be the case. Brazil is not going to be a developed economy, in my opinion. It's always going to be an emerging market. And an emerging market, it never emerges to become a developed economy. So don't extrapolate too much on the thesis. The labor issue, I mean, look, those problems have always been present in Brazil. In 2000, early 2000s, this was the time when Lula took over, right? Lula took over in 2000s, and it didn't matter because it was a time when commodities were leading the way. So I'm a big believer that, yes, there are times when politics get in the middle, but economy is the biggest driver. And so when you have a real secular movement on the inflation side and for commodities, I find it difficult to believe that the emphasis will be on corruption and labor markets versus...
As they say, the tide lifts all boats, right?
Yeah,
and in this case, that's going to be the tide.
The problem is then people say, well, are you saying it's not relevant to corruption? No, of course it's relevant. Of course, it has to be priced accordingly. That's why those things are cheap, right? That's why they're trading at cheapest levels we've seen in many decades. And so in my view, I think we can see a large appreciation of the economy as a whole. I like to own the natural resource companies. I'm watching the banks. I want to buy the banks. They're very cheap and businesses that make a lot of money. And there are other businesses that I like as well in Brazil that I'm quite interested to own. But this is a good trade, Brazilian real versus the Chinese yuan. I think that's going to break this line, and it's going to go a lot higher, in my opinion. Just looking back in China, which I think is the biggest issue in the world, when you think about black swan events and problems, I think about China, banking assets growth that we've seen, the largest growth we've seen, dwarfs anything we've seen in other developed economies. And then people may say, well, but you're just looking at the growth in assets. Well, no, just look at the banking assets relative to GDP. It's about 3 times of their GDP. Hong Kong is about 9 times. And so in my view, this is a classic sign of a credit imbalance that we have. And just to finalize, I talked about the declining 33% of the currency. I'm not going to go through that again. Back in 2015, my final point, we looked into banking and currency crisis, what they call twin crisis. And there was a good paper for Glick, Professor Glick and Hutchinson's, and they wrote a paper about what is the checklist for those currency crises. Usually you have, the declining trend of foreign reserves. That's number 1. Foreign reserves relative to M2 money supply being very low. That's number 2. Incredible growth of banking assets, incredible size of banking assets relative to GDP. That's number 4. And so the list of China in terms of that is actually checks a lot of those lists. And in my view is one place that we're seeing already. I think China is much closer to an implosion and a trigger of a twin crisis than of winning an hegemonic war against the US, in my opinion. And so I've been of that view. And so in that paper, you hear the definition of a currency crisis as a speculative attack on the foreign exchange value of a currency, resulting in a sharp depreciation or forcing the authorities to sell foreign reserves, exchange reserves, and raise domestic interest rates to defend their currency. In my opinion, this is what's probably going to happen in China. And so it's just a hedge in the portfolio. So we're long commodities still, nothing changed there. We're short equity markets, mega cap, credit spreads, things like that. And then also long the dollar versus the Chinese yuan, long the dollar versus the Hong Kong dollar, and that's about it. That's really the simplistically speaking, that's the way we're positioned.
Perfect. Tavi, as always, it was very enjoyable and informative watching your presentation. From what I see, people appreciated you being here. Tell us something. How can people reach out to you?
Well, they can reach out to me on Twitter. I'm always very vocal on Twitter. And so at Tavi Costa. And also, if you go to our website, you can find information about our funds at crescat.net. I'm sorry, not at crescat.net is the website. So
do you want to put it in the chat for people to be able to?
Sure, I can do that. I'll do that here in a minute. And also, yeah, we write a lot of letters. I mean, we just wrote a letter right now called the Golden Era of Macro Investing. It's my firm belief that folks that know value investing, that understand, things like Brazilian markets will do very well in the following years. People that understand commodities, that understand macro well, will do very well versus what we saw in the prior 10 years, which is really growth investing and some other strategies that did well. But I think we're changing, and those are going to be the things that will be favorable in this environment.
I put the link on the chat, by the way.
Oh, thank you very much. I see
no
it.
problem.
Yeah.
Great.
Tavi, thank you for joining us. Hey, real quick, can you explain just the Brazilian election? Do you have a runoff coming up?
Yes. So it's going to be next Sunday. We're going to see the results, and it's very difficult to find research on who is likely to win right now. I mean, I think it's very biases, most of those research. I think there is a very significant chance Lula will win. And I'm prepared for a pullback because the market has been moving up recently on the back of improvement of the likelihood of Bolsonaro winning. And so, people are buying the rumor to then sell the news. I'm getting ready for a little pullback. And if that happens, if it doesn't, I'm okay with it too. But if that happens, it's going to be a time when I think we're going to accumulate a larger percentage in that theme. And if there is an event of a global recession where things get cheaper, we're going to buy there as well. So that's kind of the plan going forward. But I think, 3 to 5 years, I'll be surprised if Brazil is lower, not higher.
That sounds great. And great plan of action, I think. So,
yeah, I mean, it's important. You don't come into a trade or an investment idea. You come in thinking, okay, that can grow to a 20%, 25% of my portfolio. How do I get there? Well, I'll start with 5%. Market declines, I'll get up to 7. Oh, market declines more, get up to 10. And you kind of build that position over time. And you can change that target too. I mean, as you become more convicted in that trade, things can change as well. So, so that's just one side of the portfolio right now.
That's awesome. All right, Tavi. Well, I want to say, and I know Steve just said it, but thank you so much for spending your very valuable time here on a Sunday.
It was a pleasure
with our community.
Oh, you guys are great. So I'm always happy to be here and happy we made it work. I had to go to church. I always go to church on Sunday mornings. And so thanks for adjusting the time for me to be here. So I appreciate it.
Our pleasure, my friend.
Thanks.
Have
guys.
a wonderful rest of the day.
All right. Take care. Bye.
All right.
Bye-bye.